The risk you should be concerned about right now is not recession, depression, interest rates going down. Owning bonds, having 40% of your portfolio in bonds, does not hedge you against that risk, okay? Kathy Woods are huge short. Well, money ain't going to be free no more. And so I think valuation is going to matter.
Very pleased to welcome to the show George Noble. He is a managing partner at Noble Capital Advisors. He's had a very long career on Wall Street, having worked at Fidelity in the 80s from 81 to 91, formerly an assistant to Peter Lynch. He managed the Fidelity Overseas Fund. And at the time, it was the number one fund in the country in 1985, up 79%, and this number two fund among all funds over 6 years. He managed two $1 billion plus hedge funds, Teton Partners, and
Gerfalcon, David, I still can't pronounce it. It's Gerfalcon. I hate that name.
Oh, how did you come up with that name? I'll get to that. But George, great to have you on the show. Can't wait to get your wisdom. We're going to talk about markets and the economy. Welcome.
Thanks for having me, David. I'm a huge fan. Long-time viewer, first-time participant.
Thank you for your kind words, George. Let's take today's market action and pair that with your experiences managing a bunch of funds, especially in the overseas space. So international markets versus American markets, where would you lean towards right now in 2026?
So, the story of the last decade plus has been U.S. exceptionalism and tech stocks in particular. And the outperformance of U.S. tech stocks is justified by an extraordinary record of sales, revenues, and earnings increases. I think we're going through a regime change right now. R is not for recession, it's for reflation and rotation. As you know, David, the S&P 493 massively underperformed the S&P, the Mag 7 for a good number of years. That's now in the process of changing. Look at how the markets have started off year to date. Most of the Mag 7 are down. I don't know where we are exactly mark to mark the last few days, but the non-U.S. markets, the emerging markets, energy stocks, gold miners, et cetera, reflationary plays broadly defined are massively outperforming technology. And so that's really the story for me. I mean, you want to make a big market call. It's always sexy, but it's a market of stocks. I think you got to get under the hood to look at the rotation. And it doesn't really matter what you think or what I think. It's what Mr. Market thinks. And Mr. Market gives you a scorecard every day, whether you're right or you're wrong. And the trends, are already changing. I mean, last year, David, people don't realize this. EEM, the Emerging Markets ETF, it was up twice as much as the S&P. It was up like 33% versus 16% for S&P, right? So there's money to be made here and lost, but it's a market of stocks.
You have a Best Stock Ideas online summit, which we can talk a little bit more about towards the middle of the interview, but just give us maybe a few best stock ideas. If you want to name specific names, you can, but if you don't, just give us themes.
Okay, I want to stay with themes because honestly, I don't even know the names to be fair. But we have, and this is really the varsity team. It's 15 guys, some of the best of the buy side.
That's right.
Best of the sell side, independent research guys. Some of these folks actually been on your show. I think Tavi Costa's been on your show in the past. Okay,
yes.
So Tavi's coming. Don Durette's coming. Okay, those are two of the leading gold guys. Huge followings, up over 100% last year. So I'm sure they're going to recommend, I don't know if it's a gold stock or silver stock, something like that. So that's a theme. Energy as well. Robert Mullen of MRA Advisors. He can't say this because he's running a hedge fund. I can say it. David, he was up 107% last year. All right. I know as of like 2 weeks ago, he was already up 35% this year. All right. These guys are money makers. All right. Tom Chanos runs a short selling boutique, brother of Jim. He had Freshpet as a short idea last year. It was a great idea. Tom Thornton,
how did you pick these guys to be part of your lineup? I mean, what was the criteria?
Well, these are guys I've known in many cases for sometimes as much as 40 years. I mean, we were talking offline before the show started. You've had Louis Gaba on your show a number of times. I've known Louis and his father. I've known Charles Gave since the 1980s. So this is my Rolodex, basically. And so the theory behind this conference is bringing the varsity team, the best of the best. And what's amazing is you get in 7 hours of programming, no nonsense, no fluff, just ideas, one after another, 15 guys, 15 speakers, $99. $99. And there'll be replays available in 24, 48 hours. So we're trying to democratize finance. That term's thrown around all the time. I hate that term. But back in the day, David, there used to be like stock ideas. You go to stock dinner with some other hedge fund guys. Price of admission was an idea. You come away with 15, with a bunch of ideas. We're trying to deliver that experience to the individual investor. And so this conference has no peer. I think this will be the best investment conference that the world has ever seen.
So we'll put the link down below. Follow the conference and sign up if you want more details. George, just give us a few themes that you expect these speakers to be talking about at this conference, and generally just themes that you perhaps agree with.
Sure. So I know, David, you've had a lot of folks on over the last year championing precious metals and the debasement trade. I think that trade still works. In particular, I like the miners enormously. I know you know all this, but just for the benefit to repeat, the most recent numbers we saw out of the mining companies, they reflected, I think, on average, like $4,100 gold, $4,200 gold. Gold's $5,200 today. All right. So the earnings leverage is unbelievable with these companies. They're incredibly cash flow positive. And as someone pointed out to me the other day, a good friend of mine, he said, George, why'd the Mag 7 do so well over so many years? I said, well, because they had good earnings. He said, yeah, but there's another factor. As they were so cash generative, so cash flow positive, they kept buying back stock. It was a constant bid for those stocks. Well, guess what the miners are doing? They're buying back stock. So I really like the miners. I could throw a couple names out there. SSRM is one I really like. Equinox Gold is one I really like. I think some of the copper plays are interesting. The silver plays are interesting. So I think mining is an area where
Do you own these stocks?
Excuse me?
Do you own those stocks?
Yes.
Okay.
But it's less about picking the right one, more about just do you want to be in that space or not. So I like that area. I think energy, we were very lucky. We turned bullish on energy in December. Out of favor, under-owned. There was a narrative running around that the world's awash in oil. How'd that work out? Inventory is declining. Production is robust. As you know, David, the depletion is such 5% a year, where if we don't keep drilling, we're going to start to have a decline. And now you layer on top of it this whole geopolitical mess we have. So in other words, had we done this interview 2 weeks ago before the Iran situation erupted, I would have told you the same story. As I said, I gave an interview in mid-December. We got very lucky. We recommended Schlumberger, Valaris. I was more into the services companies than I were the producers, because that's really where the operating leverage is. But, we already had the gold stocks and the miners. And I was like, let's give the folks something new. And when you think about it, David, all right, the fact that energy, even now, is only 3% of the S&P. I mean, NVIDIA is like 7%. That's crazy. So just if a little bit of money comes out of Mag 7 and goes into energy for $50 in double jeopardy, you tell me what these stocks are going to do. So I'm very bullish on energy. Our good mutual friends, David Hay and Louis Gave, we're all on the same page. And the events of the last week or so only reemphasize, underscore the need to own energy. It's not the reason we were in energy. And if there's a cessation of activities in the Mideast, it's not a reason to sell energy. The fact you have oil prices going up and down 40% in one day, that's craziness. That tells us it's a broken market. But I'd like to point out to you, I was reading one of Louis' pieces just the other day, and he pointed out that, the market's remarkably complacent about this energy situation. And he points this specifically to the futures market. Whereas the spot price went way up to 110 or wherever it went up, the futures market for oil didn't really move very much. So that's telling you the market thinks this problem is going to get solved, which in turn, to me, indicates a lot of complacency. What if it doesn't get solved? And I think potentially it could have a really disruptive impact on economies, accelerate the inevitable credit crisis that we were going to have. We can talk about that. And so this just puts everything on tilt. And if someone says, well, George, imagine tomorrow peace breaks out and so much for your energy stocks. No. Iran was never the reason I recommend energy stocks in the first place in December. So I think energy is good. I think the metals are good. I think emerging markets are good. Basically, just get away from the U.S. and get away from the U.S. bond market, get away from U.S. tech stocks. Hopefully that answers the question.
Before we continue with the video, let's talk about a company that's building serious gold leverage for the long term. Our sponsor today, Stellar Gold, is sitting on 3 major Canadian projects. Tower and Colomag are among the largest undeveloped gold sites in the country. The Tower project alone could be worth $2.5 billion after tax at a $3,200 gold price assumption. And if prices go higher, so does its value. Colomex spans over 1,000 square kilometers of greenstone deposits and could be Canada's next big gold camp. They also have Hollinger Tailings, a cleanup project that could deliver near-term cash flow. Across all projects, they've drilled over 16 million ounces of gold, which would cost over $2 billion to replicate today. With a seasoned team, Stellar Gold is one company to watch. Scan the QR code here on screen or visit stellargold.com/David Lin to learn more. Well, yeah, let's talk about U.S. tech stocks. Right now, I have this article in front of me. Perfect segue. The great software stock rout of 2026 may just beginning, says Goldman Sachs analysts. Here's a paragraph here. One lesson from historical examples of industries facing disruption risk is that share price stability requires stability in the earnings outlook. Newspapers, for example, face risk from technological disruption. As the internet grew in the early 2000s, the share prices of the group declined by an average of 95% between 2002 and 2009. Goldman Sachs strategist Ben Snyder said in a new note. Are software stocks the new newspapers of 2026?
So, as Donald Trump famously once said about healthcare, it's complicated. I think there are going to be a lot of winners and losers out of software. I think it's a very good article. What it really points to is the enduring uncertainty. In other words, the things that are plaguing software stocks now, just how disruptive is AI going to be? And let's be clear here. There are some stocks which are going to be relatively unscathed by AI, and they're being sold. And there are other stocks, software stocks, which are being sold and should still be sold. So, for instance, is Adobe having its Kodak moment? Because a lot of people look at Photoshop and some of the other products and say, there's no moat. What do I need this for when I could just go and chat GPT and, do it like that? So, and it's really hilarious because you know this, David. I see all these articles written and people say, wow, Adobe's really cheap. It's only on 11 times earnings and blah, blah, blah. It used to be on 30 times earnings. But that forgets that, first of all, maybe the earnings estimate's wrong. And also earnings estimates, PEs expand and contract along with perceived growth rates. So the fact that Adobe's on, 12 multiple down from 30 or whatever it was, doesn't tell you anything really. And so going back to your article, I think the problem is the uncertainty, the afflicting the sector. That's not going to go anytime soon. It's going to take a while to figure out who the winners and losers are. And again, markets don't like uncertainty. So, David, is it snowing where you are? Jesus.
It is. It's in Vancouver. I'm in Vancouver on the West Coast. And it was up until today, 43 years without, I think it was something 43 years, first in 43 years without snow. And I guess I spoke too soon. But
there we go. Yeah. Okay. So anyway, software is a dangerous area. I think in the aggregate, I would put it in the too hard pile. I would not own it. There are winners and losers. If someone really knows software well, fine, have at it. But buying software right now is, if you just looked at the chart, you don't know anything else, just the chart, you'd say, wait, what is this? Something's not right here. You know what? Let someone else catch the falling knife. And once it bottoms out, I'll be interested, right? So the chart looks terrible. The valuations in many cases are still ridiculous. I mean, there was one software stock, I can't remember what it was, Atlassian or one of these names. Some guy was pitching to me a week ago.
Yeah.
And he's saying, oh, it's really cheap now. It's gone from, 20 times sales and 200 times earnings to 12 times sales and, 100 times earnings. I'm like, wait. He goes, it's really cheap compared to where it was the last 5 years. I said, hold on, zoom out. How's it compared to where its software stock sold in, say, 2011? Yeah. And the fact of the matter is the valuations are much higher. So I would just stay the hell away from software. Boy, this is a real good fin porn you got. This is good stuff.
I want to get your opinion on this chart, please, George. This is these aren't exactly software stocks, but Apple and Salesforce have been spending a lot less on AI than some of their peers. Yeah. And I've been reading about some people's opinions on this and some analysts' opinions on this. And one consensus view is that Apple is quietly winning the AI war because they're spending so much less, and they're not creating their own, investing their own in their own AI. Yes. They're just using other AI, pairing it with their own hardware and creating the best hardware software ecosystem on the planet without spending a lot. And that's just one perspective. But if you look at a chart like this, you've got a lot of experience analyzing charts exactly like this. When somebody spends significantly less on CapEx in a competitive area than their peers, what are some of the first questions that you have to ask yourself as an investor?
That's a fabulous chart you have there, David. You know, let's assume, I'm going to be negative on AI. Okay.
Sure.
Let me be very clear here. I'm not negative on, I mean, I use it, but when I say I'm negative on the stocks because I think there's a huge mismatch between the monetization opportunity, how much money they're going to earn, and what's implied in the valuation. So let's go back to 2000. History rhymes, doesn't repeat. So if you had said to me, gee, I think the internet's going to be a big deal, buy all the internet plays, AOL and, MySpace and Ask Jeeves and all that nonsense, Yahoo. Well, you would have been right and you would have been wrong. The internet turned out to be a big thing. The only problem is all those stocks that you could have bought in 2000, 2001, they went down 90% or bust. So, Amazon didn't become a thing. And, Amazon went from like 100 to 9. And that's gone up 200x since then or whatever. Okay. So there are the companies and there are the stocks. And often is the case. In fact, your alma mater, bank credit analyst, has a chart of this. I saw it the other day. It's a general proposition. I had a graph of across all industries, the companies that spend the most on CapEx and the companies that spend the least.
Yeah.
And the ones that spend the most are the worst performers. Because that's the answer. So, and I'll give you one other one. I know we got other topics.
I don't mean to interrupt you, but just to illustrate your point, this is a 5-year chart of Apple and Amazon. Amazon spent $80 billion this year on CapEx, and
Correct.
Amazon has lagged behind Apple in the last 5 years. But maybe they're preparing for the future. Maybe the next 5 years is going to be the other way around. I'll let you.
Yeah, Dave, let me give you another example people can understand. Look at Toyota. All right.
Okay.
The world's largest automaker, or whatever. Okay. Toyota is not one to be on the cutting edge of innovation. They're very good at executing and producing, right? Mm-hmm. So when a new thing comes out, they let somebody else go first. So like look at EVs, for instance. Okay. Toyota was a late adopter. They went the hybrid route as opposed to all EVs. So, but what Toyota is very good is let somebody else go first. We'll have David Lynn, George Noble Motor Company. Let them go first. Let them blow themselves up. See what mistakes they made and learn from that and then go approach the market. Okay. And that served them incredibly well. So there's something to be said for we're not talking about network effect here. So the idea of first mover advantage does not apply. Better let somebody else go first, see how they lose and then learn from that experience. And I think that's what Toyota does. I think that's probably what Amazon's done with Apple. You know what? Tim Cook, he's a good steward of capital. He's probably looking at the trillions, hundreds of billions of trillions of dollars being spent. And forget about the excitement and the narrative. He's probably saying to himself, where's the cash on cash return? Where's my payoff on this? He's very good at numbers. He's like, this doesn't make any sense. But the flip side of it is these other companies, it's like an arms race. It's been viewed as an existential crisis. It's like mutually assured destruction. You and I are both doing AI, right? So you're spending tens of billions. I'm spending tens of billions. I'm afraid to stop spending because if I stop spending, David's going to keep spending.
Yeah.
And if he keeps spending, he's going to win. So I got to keep spending. So what happens? We all keep spending together and we just drive the car off the cliff. In my view, that's what's happening.
Maybe semiconductors are the play. Some people are saying semiconductors are the new oil. And it doesn't matter if you're long Apple or long Amazon. Everybody needs semis. What do you think?
You ask really good questions. That's what I think.
I have a really good team helping me with questions. Just put that out there.
All right, good. There you go. There you go. Semis are a tough one.
Yeah.
I think semis would be on their past due date. And the reason is, the company is doing spectacularly well. I have one friend I speak to every day. He's like, oh, Morgan Stanley, one day they raised their Micron estimate to $40, $50, $60, $70. Like, enough already, right? He's like, but George, the stock's only 4 times earnings, whatever the number is. And if it goes to a market multiple, it'll be 1,500. It's like 400 now. I'm like, no. The problem with Micron is not the PE. The problem with Micron is their business is so far above trend and the margins are so far above trend. If you look at the history of semiconductors, I know people say, well, it's different this time. We'll get to that. This is a bad time to be buying semis. Forward returns from this point in the cycle are horrendous. Now, right here, right now, nothing wrong has happened. However, you already see the capacity announcements for more capacity from, the industry's become like a oligopoly, but the profitability is so high. You're seeing new capacity announcements. That capacity is not going to hit anytime soon. It's going to be like 2028 before it shows up. But what that implies is that the window of excess profits for the semiconductor companies is relatively finite. It's limited. So the way I look at the semi stocks, rather than looking at the PE on current earnings, like shipping stocks, earnings go to the moon because day rates go up and then they collapse. So to value shipping stocks on insanely high temporary earnings makes no sense. That's what we might push back on semis. And so I think what you got to worry about, I mean, look, you buy semis here, you may make money, but there's no margin of safety. And when you're buying Micron at 6 times book value and you look where it tends to peak and trough, this is like, I don't know if you're much of a basketball fan. Raptors are kind of doing okay this year. But, you may take a shot from 35, 40 feet out. It may go in once, but try that shot 10 times and tell me what happens, right? So to me, buying semis here is a bad play. May still go up. It's just not for me. And I think with a short-term view, I think forward returns looking at 12 months, 24 months are going to be pretty poor for semis.
Let me just ask you this from an investor's standpoint. Why do valuations matter if you know something is going to be in demand for the foreseeable future, pretty much like a consumer staple at some point?
Valuation in the short run is useless as an indicator.
Yeah.
Okay. But let's say, I'm going to take a ridiculous example. Okay. Let's say Beanie Babies are in fashion. They were once upon a time. And you and I decide myself, I'm going to open a Beanie Baby factory. And you decide you're going to do a Beanie Baby factory and your producer's going to do one as well. Okay. So it may take a while for the Beanie Baby factories to come to excess capacity to come along. But the bribe that entrepreneurs are being offered to produce Beanie Babies is so high. It's the moral obligation of capitalism to arbitrage away these excess returns. So it's only a question of time before David Lynn Beanie Baby Company comes along or George Emble Beanie Baby comes along, right? So in the short run, this is irrelevant because it could take 2 years for Lynn to get his factory going, right? So valuations don't matter in the short run, but the longer you go out, the more they matter. And, listen, if you're a trader and you say, hey, I'm good with the charts, I know you have a lot of good technicians and charts on, and I'm good. I don't care about fundamentals or fundamentals as they call them. I'm just a chart guy. A number go up. And I use stops and discipline. The minute it rolls over, I'm out. Okay, have at it. Okay, that's not the way I roll. Okay, I'm burdened by my training at Fidelity. Okay, being a fundamental investor. And I'll tell you one last story on this point. So I just, I started up my Substack recently. I just went to put a paywall up a few weeks ago. So aside from having a portfolio, we also recommend individual stocks. So I had to write a report. You're going to laugh at this story. I had to write a report. I hadn't written a report in like 35, 40 years. I said, all right. So I go dust off one of my old Fidelity reports I have to write for Peter Lynch, called Investment Committee Report, ICR. So the first pick was Southwest Airlines. I had heard Southwest Airlines pitched at a conference 2-3 months ago. Cost cutting, Elliott management, evaluations of a third of Delta and United Airlines based on price to sales, blah, 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 blah. And then I saw in January, Jamie Baker, who's the leading airline analyst on the street at JP Morgan, he did a double upgrade. He upgraded Southwest Airlines from a sell to a buy, not sell to hold, sell to buy. So I'm like, something must be going on. So I go and I look at the numbers and I went back and dusted off my notes from the conference. I was like, yeah, I like this story. So I wrote it up. ICR, elevator pitch, the drivers, positives, negatives, strengths, weaknesses, risks, rewards, income statement, cash flow, balance sheet, catalyst, chart. That's it. 3-4 pages. You got to give more than just number go up, but you also don't want to do one of these TLDR specials, 30-page report which nobody reads. So 3-4. So it's the way I was trained to look at stocks. So I write the report. I show it to my friend. He's like, George, nobody writes reports like this. What are you talking about? He goes, well, you're talking about fundamentals and valuation. Nobody cares about that. It's all about narrative and chart. That's all I want to know. So what I'm telling you, David, is I think we're past the point of peak narrative. I think valuation fundamentals now do matter. Look, in a world of free money, where cost of capital is negligible, pigs fly. That's what happened. Well, money ain't going to be free no more. And so I think valuation is going to matter. So
money ain't going to be free no more. Let's talk about that. So before we talk about the next 40 years, I want to look back the last 40 years, George. So like I mentioned in the beginning, you were incredibly successful at Fidelity. Your overseas fund in 85 was the number one fund in the country, up 79% on the year. If you had to run that same fund today, how would you do it differently? Where would you invest differently? Let's put it that way.
Okay, I just want to get this straight. So basically, I'm teasing you now. So basically, in different words, you basically just said, I'm a has-been, if I heard you right.
That's not what I said.
All right, I'm playing with
you were a legend. You still are.
All right. People say, oh, he's a boomer. He's got gray hair. He's, whatever. Okay. He doesn't own Ethereum. We can talk about crypto too if you want. That'll really piss off people. Whack that pinata. So, I would be underweight tech. But here's the problem. As we know, active managers have been losing the battle against passive for good reason, because passive costs less and passive has had better returns. But it's not always going to be that way. And I want to regale you with one story about the Japanese stock market. So I cut my teeth on foreign stocks. I was the initial manager of Philly Overseas Fund. Thank you for mentioning it, in 1984. And I made a big foray into the Japanese market in the 80s. And initially it was a fundamentally based decision, but then a mania took over. And, the market went to 60 times earnings, and you had Japanese bank stocks on 10 times book, 100 PE, all this kind of stuff. So all the fundamentally based investors like Templeton, Jeremy Grantham Mayo, Scott Stevens, they were all like, no, just say no to Japan. It's ridiculous, right? But I was the young guy with the hot hand. The Japanese term is Shinjin Rui, the young hot guys, right? I went for it and I won. So what happened though, Japan, my charge was to invest outside the U.S. This was the EFA index, Europe, Australia, Far East, the non-U.S. S&P, if you will. And Japan went up so much that it got up to the point where it was 65% of that index. I think today it's 11. And so if you're competing against that index, you had to own Japanese stocks. Otherwise, you couldn't keep up. In the same way,
real estate at one point, Tokyo real estate was more expensive collectively than all of California or something.
Correct. Exactly. The Emperor's Palace, you got to remember, the Emperor's Palace in the middle of Tokyo was worth more than the state of California. It's complete insanity. By the way, Japan's incredibly cheap right now. If you're looking for a place to go on vacation, go to Japan. So anyway, so it was a tyranny of the benchmark. You had to own Japanese stocks. Otherwise, you couldn't keep up. In the same way, the last few years, if you didn't own U.S. tech stocks, you couldn't keep up. So, but here's the problem. Back then, the style guys, they didn't put you in these boxes where, Dave George, tech's 35% in the index. You're only at 5%. You can't do that, right? They would define risk, not just as the risk of losing money, but more importantly, from an institutional standpoint, the risk of underperforming the benchmark index. And that's a much different thing. So most real money guys, like if I was back at Fidelity now, I'd want to be underweight tech, but they limit you as to how underweight you could be because they don't want you drifting too far away from the benchmark. But my overall view wouldn't change. I still think you'd want to be away from expensive U.S. tech stocks. And I think you'd want to be away from companies with bad balance sheets and away from shitcos, selling on 30 times sales. Another phrase I coined recently is death of speculation. By that, I mean all the companies that benefited from free money. The tide was coming in, the tide's now going out.
Which jurisdiction or country you would be more overweight now if you were to run the overseas fund again? You mentioned Japanese cheap right now. You mentioned American exceptionalism maybe coming to an end. So where would you go?
Yeah, very good question. You forced me to bring my A game. Note to self, I'm going back on Lynn's show next time. Be more prepared. Countries are one thing, but it's also sectors and industries. So for instance, why has Korea done so well? Why has Taiwan done so well? It's got, Hynix and TSMC and all these things, right? So you can break down each of these indices into factor bets and sector bets. So for instance, all things being equal, which they never are, Europe has no tech to speak of. So in a world where tech's doing well, if that's all you knew, Europe is going to underperform. All right. In a world where commodities and reflation are the name of the game, I think our good friend Louis Gav, who I believe you had on the show last week, would tell you emerging markets. Because these countries have higher real interest rates, therefore greater scope for rates to decline. They have, believe it or not, better fiscal situations, better budget situations than we do. I mean, the US right now, and Europe for that matter, we have almost no flexibility when it comes to monetary policy and fiscal policy. Okay. We're going to have a Liz Truss moment one of these days where the market's going to say, no mas, US bonds are going to get sold. Real rates are going up, in my opinion. Real rates are bad for equities. So I get away from the US. I'd be in selected emerging market countries. I own the resource plays. I own the energy stocks. And those could be in any countries. So it's less about countries and more about sectors and factors.
I want to come back to that Liz Truss moment comment. Why would the U.S. experience that? By the way, you have a podcast that I want people to be aware of as well. This is the Market Talk with George Noble show. And,
correct. Thank you. Thank you for mentioning that.
You had a guest on recently that told you about this, right? I think it was Albert
Saporta. Great. You should have Albert on. He's a great guy. He's not really that widely followed. Great guy. So thank you for highlighting this. So my podcast, basically what that is, every Sunday at 11 a.m., I do a space, which is great. Even though I don't like X, the one good thing about X is the Twitter space. In fact, I should have you on as a guest. It allows for interaction. It's like a giant Zoom call, as you know. So you can get a lot of really smart people in there at once. It's the only platform that offers that. So what I do is I have the space, every Sunday at 11. And then the replay gets put up on Substack, Apple, Spotify, YouTube. Aside from that, during the week, I usually do one podcast where I interview somebody. I had Louis Gov on months. I haven't had him on recently, but just the other day, I had Russell Clark on. You should have Russell on. Really smart guy based in the UK. And so it's all about investor education. I'm trying to help people just as you're trying to help people. It just so happens I've been at this longer than you. Well, I don't have your hair. I have a bigger Rolodex. So that's how I get all these people.
I believe Albert told you that the U.S. is 75% of the global market cap.
Correct.
But only about 25% of global GDP.
Correct.
I mean, one will look at that stat and think maybe that's not sustainable. Or maybe it is. You're assuming that American hedge money would sustain, and if so, maybe that pie will get even bigger. So you have to make a bunch of different assumptions.
But here's something for you. Okay, all right. I'm not going to predict this, but let's just hallucinate for a second a bit. Like our favorite LLM, they hallucinate. Basically, they lie. Don't you love these ChatGPT things? They give you the wrong answer, and then when you push back, they say, "Oh, sorry, we didn't mean it." Okay. So imagine for a second that I'm right about tech. Just imagine, right? Let's say tech underperforms. This is not without precedent. BCA, by the way, your alma mater, would have you believe that tech is going to underperform. So let's say tech goes into a protracted bear market in the same way that it's been in a protracted bull market. And let's say all you need to do is underweight tech and index everything else. You'll outperform. Okay. So I think that's the first thing that one should do. It's kind of like in medicine, Socratic, it was a Hippocratic oath. First rule is do no harm, right? So don't own losers. Avoid the losers. It's like Michael Chang. You remember Michael Chang, a tennis player? Okay. He was annoying as hell to play against because he wouldn't hit winners, but it's like playing against a machine. He'd always hit the ball back. You would wind up losing because you would commit an unforced error. Okay. So if we just say, hey, David, you know what? We're not going to try to find the best stock to buy. We're just going to identify the ones we shouldn't own and avoid the losers. It sounds bizarre, but that's another way you can beat the index. So I think it's a great time, go back to what I said a few minutes ago, to be an active manager. There are you know what it is, David? More than any one particular idea, there's what one would refer to as dispersion. Some stocks are very expensive and going one way. Other stocks are very cheap and going the other way. Like, healthcare has been a disaster for years. Tech's been on fire for years, right? Okay. There's a lot to do here, and it's just buying the index. I think it's a very easy thing to outperform right now.
Passive funds have dominated the markets for years, but you're saying that era is coming to an end? Knowing the index itself isn't going to be enough?
They may keep putting money into index funds. Okay. But I can remind you, I learned we know this, but from my experience at Fidelity, flows always follow performance. Everyone has FOMO. So as long as something is working, the money keeps going into that area. So it could be an index fund, for instance, all right? Index funds have been killing it. David, why would you invest in another fund which has much higher expense ratios and underperforms? Doesn't make sense. It's irrational. Okay. But if we get into a protracted period where, okay, last year emerging markets killed the US. This year, the same thing is happening. So eventually it's going to get to a point and it's going to say, well, wait a second. The S&P was flat or only up 8%, but my emerging markets was up 20. Why am I still in the US? Oh, they're good companies, they're world leaders in technology, blah, 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 blah. But remember, we're investing in stocks, not the companies. It's two different things. A great company at the wrong price can be a bad investment. A mediocre company at a good price can be a great investment, right? But the key point, to answer your question, is flows follow performance. So if we get into a situation, well, let's just say, hypothetically, tech underperforms. Eventually, people can say, well, wait a second. Why do I have all my money in this index fund? I put money in index fund. Yeah, it's 40% that's going to tech, right? Or bonds. Bonds are a disaster. We haven't spoken about bonds, right? Some have said recently, Louis Gobb would tell you, I agree completely. Bonds do not hedge you against the risk that you should be concerned about. The risk you should be concerned about right now is not recession, depression, interest rates going down. It's the opposite. It's more, we're going to keep printing money, recording possible inflation, higher interest rates. Owning bonds, having 40% of your portfolio in bonds does not hedge you against that risk, okay? So Louis would say, and I agree with him, and by the way, if I sound smart for all you viewers out there, it's not that I'm that bright. I listen well. I watch David's show. I've read GovCal research for years and guys like that, David Hay, and I'm pretty good at remembering what they said. No, I'm teasing, okay? I'm not stupid. I work hard, but they're completely right. Completely right. So rather than owning bonds, you should take that money and put it into energy and gold. If you want to hedge it against, this is 60-40 portfolio. I know you didn't ask the question, but I'm asking it anyway. 60-40 portfolio we were worried about hedging against the risk, which in the past was recession, depression, interest rates go down. That's not the risk right now. The risk is we keep spending money like drunken sailors and we get inflation.
So that goes back to valuations. You've just listed two assets that have skyrocketed in recent times. Oil's gone up to $119 at its peak just 2 nights ago. Now it's back down to about $90 a barrel, WTI. Gold's gone up 200% since basically a year and a half ago. Even now, you would say, put money in gold and oil. How would you answer the question if someone would ask you, hey, it's already gone up a lot, George. Maybe let's go to something else that's
okay. So let's start with energy first. Okay. So again, the shiny object. And I think I said this, but I'll mention it again. Avoid the hot takes. Everyone, it's the volatility, the hot potato that everyone's watching every day. Ignore that. Okay. Yes. Had you bought oil yesterday at 119 or whatever the price was, or 109, I get confused with silver, and now it's 85, you lost 40% in 12 hours. Ha ha ha. We told you. That's not investing. Here's what's investing. Oil today, wherever WTI is, Brent, I lose track of all the numbers. You look at Brent or WTI, it's lower now than it was pre-COVID in nominal terms, and it's down significantly in real terms. So oil is extremely cheap. And the oil stocks are also extremely cheap. So the reason I like the service companies is we're going to have to drill for more oil. Offshore, Permian's not the answer anymore. It's, whatever. There's going to have to be more drilling activity. Even if oil prices don't go up, I think these stocks can do very well even in an environment of flat oil prices. But I think it's a good chance oil prices go up from here. So they're cheap relative to history. They're cheap relative to everything else. That's how I would defend energy stocks. Gold's a funny one. There is no intrinsic value. Gold is what people as a store of value decide it's going to be worth. And as you know, Dave, you had many guests on talking about this. Ever since the Ukraine situation arose in 2022, and, we confiscated billions from the oligarchs, everyone around the world is looking at the U.S. and saying, wait a second, we thought the U.S. dollar was sacrosanct, was a safe place to park money, blah, blah, blah. Well, now we see the U.S. is not so nice all the time. And maybe we should think about diversifying away out of U.S. dollars. So most notably, the Chinese have sold off huge swaths of their bond holdings in recent years. Um, you see foreign central bank holdings of dollars of bonds going down, and money's looking for a home. It's going elsewhere. Problem is, there's no other candidate to take over the role of the world's reserve currency, and so gold is a frequent protocol for a lot of those funds. And keep in mind, gold really has been driven not by U.S. investors. It's been foreign central banks that have been buying gold, trying to diversify their way out of U.S. dollars. I believe that's going to continue, regardless of what the price of gold is doing. And a lot of Asian demand. It's funny, if you look in the U.S., total holdings of gold by ETFs has actually gone down the last few years, not up. These are things you don't see at the top. So in the gold stocks, I had a great interview with Zachary Marks just yesterday. It's on my Substack, on my YouTube. He made the point, and he's right. He said, "You know what, George? I think the price of gold will go down 20% from here, and we're still going to make 50% in the gold stocks." What? Because, George, look at the valuations. Look at the cash flow. They're doing this at 4,100. Gold's 5,200 right now. And by the way, sidebar, David, gold's 5,200. We're just within a few percent of the all-time closing high on gold, despite everything that's happened, all the volatility. The gold price of gold's hanging in there. The gold stocks are hanging in there. Okay, yeah. So the worst than silver, okay, that's the redheaded stepchild of precious metals. Silver was doing just fine. It's the high beta, poor man's gold. We know that. You know what else? You know what's the worst thing you can say about silver is it overachieved. Silver was doing just fine, thank you very much, until Crypto Bro, Growth Bro, and Momentum Bro discovered SLV is their new favorite meme stock, the silver ETF. They piled in, and silver just went completely vertical. All right, so it's pulled back to trend. I think I'd be buying silver stocks right here, right now. It's funny. I want to say I want to put in a bad word for Bitcoin, just so I can offend everybody. So in a space a few weeks ago, I was talking about why I'm negative on Bitcoin. I have no position, by the way, on Bitcoin. No position. And people say, "Well, why are you negative?" Well, you can have your beliefs in your portfolio, two different things. You don't have to invest in every belief you have. But I think Bitcoin is very uninteresting. I think Bitcoin is done, toast, finito. Bitcoin was the speculative asset with all this liquidity. And the institutionalization of Bitcoin is actually a huge negative, not a positive factor, because that's where the marginal dollar came in. And as we've observed, the volatility of Bitcoin has gone down. That's a negative, not a positive. In most other asset classes, when volatility goes down, it's a positive. Not in the case of Bitcoin. Why? Because Momentum Bro and Crypto Bro, they like the high vol, like, get rich quick. Like, put it in, we can make 40% in 1 month, right? Bitcoin has lost its mojo. Vol's come out of it. All right. Allied to that, you see the proliferation of other more volatile asset classes. So the precious metals volatility has increased, prediction markets, sports betting. By the way, I guarantee sports betting is making it top. You know why? Because I opened up a FanDuel account. So even I'm using it now. All right. Bad joke. So there's a whole investor class out there, the sort of so-called degens. They want the juice. And Bitcoin's lost the juice. Last story I tell you in this regard, I was doing a space a few weeks ago. So this young fellow comes in and he's like, "Oh yeah, George, I agree that gold and silver, I'm all in. But, I think you're wrong about the volatility on Bitcoin." I was like, and he goes, I said, "Really?" I said, "Tell me something. Why did you sell all your Bitcoin to buy gold and silver?" He goes, "Well, because they're going up. Bitcoin wasn't." I said, "Thank you very much. You just proved my point." All right. So I made the incendiary comment a few weeks ago. You'll get where this is coming from. Talk about whacking the pinata. I said, Bitcoin is the Facebook of speculative assets. In other words, so Facebook's for old people, for boomers like me, right? Like Bitcoin is so yesterday.
Does it have a place in your portfolio? Let's talk about allocation now. Let's say you're managing $1 billion fund. Again, so you've got.
Wait, you're giving me your account to manage? Thank you. Sorry.
No, I'll give you $1 billion Zimbabwe dollars to manage. There we go.
There you go.
George, how would you divide that? 60-40, or would you do something differently? Alternative assets, hard assets, digital assets, for example, Bitcoin,
All right.
versus stocks and bonds.
So for normies,
Yeah.
no crypto, no Bitcoin. By the way, one last word on that. Michael Howell, who I think you've had on your show, another good friend of mine. He's written extensively of late as to why Bitcoin is doing poorly and gold is doing much better. First of all, he's a bit more cautious on markets globally just because the liquidity picture is deteriorating. This is before the oil thing with Iran. He has the bona fides to have an opinion because Michael, I can recall in the fall of 21, he was bearish, I was bearish. And then he correctly turned bullish in the fall of 22. You know, David, you have many people on this show. Some guys, they got the crash right, but then they don't get the recovery right. There are other people who are perma bulls. They always miss the crash. There are a few people who get both right. Michael Howell's one of them. So he has a license to speak on this. He points out how one of the big differences between Bitcoin and gold, they're both stores of value. However, gold is being bought by the PBOC and foreign central banks. Bitcoin, not so much. Bitcoin depends on U.S. liquidity. PBOC depends on global liquidity. Gold depends more on foreign central banks and global liquidity. It's a big difference. Coming back to your question, I'd have zero in bonds, zero in crypto. If you're going to be in equities, you want to overweight the things that are going to benefit from the trends that are in place, from the reflation and the inflation. So energy, gold miners, metal stocks, copper stocks, emerging markets, underweight the U.S., underweight U.S. technology, underweight long duration, expensive high PE stocks. Those would be kind of buy Japan. Those would be the broad brush strokes that I would give someone in portfolio construction. So your portfolio would not look like the S&P at all. It would look very different. And again, I think the returns, as I always say, David, past results are no guarantee of future performance. Well, I think that's what who would have thought? I mean, as absurd as this sounds, because we all suffer from recency bias, we're all human. Who in their right mind? No, I don't know anybody who in 2015 predicted the tech stocks were going to do what they did. Imagine you had today's Wall Street Journal in 2015 and you came on my show and you said, okay, I think tech stocks will go up 20x after everyone else. You're going to laugh you out of the joint. So we'll have recency bias. I'm telling you right here, right now, again, valuation is no use in the short run. Right here, right now, I think you look back at this period in time, a simple decision, avoiding U.S. exceptional division, avoiding expensive tech stocks, and avoiding U.S. bonds, if you just did that, you don't have to get too clever. No short NVIDIA, which, by the way, I think is a short. I'm not telling you to short stocks, but if you're a pro, there's a lot of stocks to short. I'd short Tesla. I think Tesla's worth $20. I think all the shitcos, meme stocks, they'll go down 90% from here. Kathy Wood's ARK, huge short. I mean, I got so many shorts, but I don't advise it for individual investors.
Why not for individual investors?
Shorting is risky. I mean, shorting the problem. It's for here's the problem, Dave. One of the biggest problems with shorts. It's not just, people say, well, when you buy a stock, it can go up 10x. When you short a stock, it can only go down 99%. So it's asymmetrical. There's a worse problem than that. And that is, if you find a good company, whose sales and earnings go up year after year, odds are the stock's going to do pretty well.
Tesla's worth $20? Sure. You don't believe in the...
No. I said, if you find a stock which sales and earnings go up year after year, the odds are the stock will do pretty well. Okay?
Right.
Conversely, shorts, most of the time, unless it's something terminal, like it's a scam, it's a fraud like Enron.
Yeah.
So you have David Lynn Enterprises, a good company.
Yeah.
Maybe management's a little sleepy. But, so they miss a quarter because they were budgeting for high sales. The sales didn't come in so great. Fine. Mm-hmm. So they have a bad quarter, stock sells off. But Lynn's smarter than you think. He says, all right, you know what? We're going to cut back our budgets. So we're going to get our expenses in line with our revenues. Next quarter, back to our regularly scheduled programming. Earnings are okay. So the problem with shorting, it's a very labor-intensive process. In other words, you make 20%, 30% of short, and then that's it. And all the hours you spend trying to figure out the short goes out the window. As opposed to if you have a long, you have a compounder. Like if you could figure out the Amazon or NVIDIA or whatever it is was going to be a good idea, McDonald's, You just ride that puppy. You just stay with it.
Let me finish off on one final question. The future. What is the AI play of the next 10 years? Is it still AI or is it something else? Robotics is something that's been coming on my own radar. I've been following robotics news and just how advanced the tech has gotten just since last year. I mean, the advancements they're making
Sure.
day by day is extraordinary. But I want to get your take.
So, candidly, I'm probably the wrong guy to be the tech guru here. I'll make a general statement, which is I'm sure they're going to be winners out of AI. It'll be the guys using the AI, the customers of the AI. So, for instance, take a stock like McKesson. It's a big drug distributor. They got zillions of SKUs. If you could use AI to make it more efficient, cut some costs, not that the sales are going to go up, but the costs will go down. It's a big winner. Or for instance, David, you go to a doctor's office, right? Think how primitive that is. What do? You go in, they hand you a clipboard, fill out this, fill out that, fill out this, right? You go to the doctor, then he refers you to a specialist. You go to the other doctor, fill out this, fill out this, fill out this, right? Dude, we got AI, we're in the 21st century. Isn't there a better way to do this, right? So whoever figures out how to make their processes more efficient, they'll be the winners. Well, the one last bad joke I'll leave you with summed it up perfectly. AI, and people say, oh, there could be a lot of winners from this. You want to sell the companies, you want to buy the companies that are selling the picks and shovels. The picks and shovels, picks and shovels, right? The best comeback on that line was, so everyone's coming to the hardware store to buy the picks and shovels because they hear there's gold in them hills. David, what if it turns out there was no gold? Everyone bought the picks and shovels, but there was no gold. And so I think, yeah, AI will be of some help. But right now, more than anything, in my opinion, it's essentially a glorified Google search. And we're spending trillions of dollars to do this. And oh, by the way, it's causing everyone's electricity bill to double. And oh, by the way, the Chinese have figured this out, and they're doing it in a way which does not cost 90% less. As I say, David, what could possibly go wrong?
Maybe China's the next play. Maybe Shenzhen's the next play.
I like China. Louis Gov likes China. China, by the way, it outperformed the U.S. not just in 2025, but in 2024. Louis Gov called your office. Hey, Louis, this is going to be the third year in a row that China's outperformed. And then they'll say, oh, you can't invest in China because they're commies and this and that. Please. I'm interested in making money. I don't want to hear about this other stuff.
How do American investors even get exposed to China?
There are enough ETFs out there. Yeah. And the other thing too, China as opposed to the US, I'm going to channel my inner Louis Gov. As opposed to here, we have an inflationary concern and there's questions about just how much liquidity can we put in the system and how much more fiscal spending can we engage in given the burgeoning budget deficits. In China, given how much inflation, there's no inflation in China. They can print as much money as they want. It's not going to matter. And also, they've got their budgets under control. So they have much greater scope for fiscal and monetary largesse, not to mention better valuations and a better secular macroeconomic story. So, why would you buy the U.S.? And again, for all the haters out there who say, oh, it's China, or George is now a shill for the CCP, nothing could be further from the truth. I just want to help people make money.
Yeah. All right. Well, speaking of helping people make money, where can we go to learn from you? I mentioned you have a podcast. You've got the show coming up, which people should look into, right? It's the Best Stock Ideas Ideas Online Summit, March 11th. Yeah, where else can we go?
It's tomorrow, 10 to 5, $99. Dude, you can't buy a dinner for $99. And I say to people, if you're not willing to pay $99 for this, then you're not serious about it. Then you don't know what you're doing. You're not serious about your money. And you know what? I'll make this promise to you folks. Trust me on this one. Anyone comes to this conference, they don't like what they heard, but explicitly tell me what they didn't like about what they heard. Not just they didn't like it, I'll refund your money. Conferences like this cost thousands of dollars to go to. This is unbelievable. I mean, I'll send you the link. I just did a little testimonial for the conference yesterday. I can't believe what we've created, but this is the high-tech world we live in. So to answer your question, I'm on Twitter, I'm on X, gnoble79, Substack, YouTube. This conference tomorrow is going to be phenomenal. If you can't make it, don't worry. Replays will be provided within 24, 48 hours. Try, and if you don't like, I'll give you your money back. So,
all right. Good. Thanks very much. We'll put the links down below. Follow George, follow his podcast, sign up to his conference, all that jazz. Thank you so much, George. Great to meet you, and looking forward to having you back again in the future.
Thanks, David. It's a pleasure.
Thank you for watching. Don't forget to like, subscribe.